Okay.
So my knowledge of options in general is very limited.
That's okay. Well,
we-
use today as a crash course then.
Yeah, I will be listening.
I mean, I hear Nick talk about like I sold some puts. It's like Nick's got just the classic Buffett style, which is cash secured puts. So you can just sell a put, collect some premium. If price comes back to you and you get filled at a price you want, that's a great place to own a stock. Cash secured puts cost a little bit more money. So I think credit spreads are a good way to get started with small accounts. So let's talk about this. I'm really weirded out by this SMCI thing. Let me go to NVIDIA really quickly. So there's my positions, options table, SMCI.
Wow, so you were in NVIDIA as well.
Yeah, so I've got NVIDIA. And again, I'm doing this with just safe credit spreads. Now we have SMCI. Okay, so now I can continue on with what I was talking about. If I wanted to go out and say, I mean, right now we're looking at the 16th for an expiration 2 days out. If I want to go, kind of my long options, if I want time to work in my favor, I'm probably going to go out about 30 to 40 days. I just want to show you how expensive this trade would be. So if we're going to do a long call and you're like, SMCI is going to $1,000, I know it. Well, then you want to go out to get yourself some time. So you go out about 40 days or so. And right here, we're trading at current price is $800 and some dollars. This is just weird. I'm not getting a live feed. Okay, so we're 865. Let's talk about this. If I did a long option, okay, so we're gonna talk options 101 today for this session. So if we did a long option, and you can have a long call, and again, I'm not trying to talk above anybody here. Some of the language is really silly. I always joke about how stupid the strategies sound. For example, Frank, if you're interested, we trade iron condors, and we trade jade lizards, and we trade calendar spreads and blah. Doesn't matter. All that matters is like if I tell you what happens in the trade, you will understand it. So today, before you leave, I want you to understand what a credit spread is. It's really simple. And so a lot of traders just do this. This is where a lot of traders get burned. Okay, long options, so you can do a long put. Okay, now let's talk about what the market does. What the market does, right? Market goes nowhere. Market goes up a little. It goes down a little. It goes up a lot, and it goes down a lot, correct? That's about all the market can do. So for us, if we are long an option, we are also, remember, paying for that option. So if we're long an option, we're going to be paying for that, which is going to be, we pay for the option, and that fancy word for paying for it is a debit. We pay for the option, and that is a debit. Now, in order for our long option to be profitable, let's say that we pay, let's use SMCI as an example. All right. So SMCI as an example.
Did you know that we have 100% free trading tools and data available for you on our website, a1trading.com right now? We have free courses for you to browse. You can also check out things like retail sentiment and free articles from our analyst Frank that include things like edge finder screenshots and trade setups. You can find all of this and so much more for free right now on our website, a1trading.com.
Where's my text box here? So SMCI is trading at $867. Okay. So again, and I always preface this with like the names are silly, but at the money, hopefully this makes sense. At the money is current price. So around 870 is at the money. Okay. If we're in the money, that means that if we're doing a long option or we're doing a call option, in the money means that price is already, it's already been at that price. So an in the money option would be, let's say 850. 850 would be considered in the money, or 800 is pretty deep in the money. So we'll do, let's say 800 is way in the money. The 870, I mean, this is right around 870, and then we can go out of the money. Okay. And again, these names are silly, but it is what it is. That's probably why, options started off with like Wall Street's little secret, but an out of the money might be like a $900 to $1,000, which means price hasn't gotten there yet, But as far as me paying for the option, it's going to be cheaper to buy an out of the money option that anticipates price gets there and that option gains in value. And in the money option is we're paying more for that, but we have at least a head start where our option's worth something with the real value. They call that the intrinsic value, is at least worth something. At the money is you want to see what SMCI is charging right now. I would not be surprised if this is like a $50 to $100 option. So before, I know you're jumping in there in a sec. Let's say that an at the money option right now is $100 debit for a long call. Okay, let's just say that's the price. That means that if I buy an at the money call on SMCI at $870, that's the strike price. $870 is the current price. Spell that right. This is the current price. And I pay $100 premium for the long call. Now we can do simple math. So what's 870 plus 100?
Is this a rhetorical question?
No, you know the answer. What's the answer?
Yeah. Okay. So 970.
970 is where we need price to be for our option to be profitable, right? So even though we're buying an option at the money, because we pay that premium, we need price to not only keep going higher, we need price to keep going higher to cover the cost of the option. So when I say what the market does, it goes nowhere, up a little, down a little, up a lot, down a lot. We actually need this market to go up a lot just to cover the cost of our option, which is why most traders lose when you're buying options. When you're long an option, when you're long a put, long a call, most traders lose because you need that directional play to not only cover the movement in the stock price, but you need it to cover the premium that you paid as well. And that is why most traders lose on long options. If you flip that around as a seller of the option, all I need price to do is go nowhere, go up a little, go up a lot. I can make money in all three of those scenarios, okay? Also, if price goes down a little, maybe even down a lot, depending on how I position my credit spread, for example, I can still make money. So I think this translates into, here's how we get into credit spreads, okay? So right now it's trading at 870. I have no interest in being close to this price, okay? So what I want to show is if I delete this for a second, let me see if I can delete these. There we go, there we go. Let's go into the options chain here. And this is being really silly for some reason. Let's see if I can get an expected move. All right, my platform is being a little strange, but let's just go look at a different strategy. Let's just look at a vertical spread and clear this out. Okay, so right now, the one thing I'm going to look at, and again, not to be confusing, but this is just a simple options chain. You can pull this up on any publicly traded stock that has options. We have daily expirations on the S&P, daily expirations on the NASDAQ. We have weekly expirations on the Dow Jones. We have every other day, so like 3 days a week on the Russell. That's what's provided a lot of liquidity for options. There's a lot of volume. I mean, single day options right now is about 40 to 45% of daily options, or all the options right now are daily and single days, which is crazy. But most stocks have weekly options as of now. So if I come into SMCI, and the one column I'm going to look at here, if you can see this, is it's a delta column. And all that tells me is if I go at the money, which we know that price is trading around 870, anything that's at the money is going to be around a 45 to 50 delta. Just for lack of better terms, like that's what it's going to be. That's at the money. I'm not interested in flirting with at the money. I'm going to give myself all the freedom to say if price goes up a little or up a lot or down a little or goes nowhere, I can make money in that trade. So if I were to position myself for a credit spread on SMCI, I would be looking to see on the put side. So I've got calls on the left and I've got puts on the right. I would go down in price. So you see me navigating the options chain here. I'm going to go down in price until I see about a 20 delta or less. So here's my negative 21 delta. Here's a 15 delta. Now this is a good price point. If all I did was a credit spread right here, which means I sell the 800 put and I buy an 800 put, it's a $5 spread. Okay. Now that $5 spread, if you see this right here, it shows that I can collect about $1.25 in credit right now. Okay, so let's do the math on that. This is what's nice. You're really just doing addition and subtraction in options. So if I did an 800 by 795, and all that means, if anyone's like, what does that trade mean? I do a sell to open, 800 put, and I do a buy to open, 795 put. Okay, now this is a credit spread because this I can afford to trade. This means that, let's see if I can go back into this here.
So credit spread is selling and buying a put.
Correct. You're creating a spread with the different strike prices. So a credit spread is you would sell the 800 put, and if you think about this, what does it mean if I just sell the put? So if I just sell the 800 put, you're going to see that I can collect a lot of premium on that, but I am on the hook. If SMCI drops down to $500, that's a $300 price point below my sell put. Now, what I'm doing as an option seller, if I sell the 800 put, that means that I am obligated to own the stock at $800. If I get assigned it, I own it $800. Now, I can collect a premium because I'm saying, look, I'll own the stock at $800. But think about that. If I had a stock go just blow through my level, and I can show you what that break even is going to be. So if I sell the put 800 and it's just that's considered a naked put. I collect premium, which is nice. Okay, so I can be given premium and given income essentially to say, hey, this guy wants to own the stock at $800. If it gets to $800 and lower, I could get assigned. But I collect the premium because that's my bonus for saying I want to own the stock. But I am exposed all the way. I'm exposed to zero on any crazy move. Now, obviously, the likelihood of that is slim to none. But the stock has gone up over 160% for the year, and we could probably have a 23% pullback or even a 38 to 50% pullback at some point. It gets really violent, and what that translates into a dollar amount, it's probably going to be $50 to $100. So here's
the question.
Yeah, go ahead.
So you're selling and buying a put.
Yes.
It's a $5 difference. So at what point, say what you said happens, it goes down to 500. At what point do you make or lose money because you're buying a put, which will make you money, but you're selling a put, and if you get assigned, you, I guess, collect premium in that amount of time you hold it, but then you'll have to own the shares. So where's the trade-off of doing both? Because like if you take a long and short position at the same time, say this isn't options, you're basically making nothing. So this looks like in some sort of way a long and short position. So I'm curious, what is the point to where you break even, where you make money, or where you are losing money?
Okay, and I just want to say this. This was not scripted or talked about ahead of time, but Frank just asked the perfect question to fully explain why credit spreads are so great. Okay. So the reason I would do a credit spread over just selling an $800 put is because if I sell the $800 put, which gives me the obligation and it gives me I have the right and obligation to own at $800. Okay. Now the reason I do a buy 795 put is because this is what is called defining my risk. So it's a $5 spread. And so this is what's nice, Frank. If the stock went from $860 all the way down to $500, I'm only risking a maximum here of $5 because of the spread. But what did we collect on this? So we have a $5 spread. We're showing that we can collect a $1.25 credit on this credit spread, right? That's what the broker platform's showing. So that means that I have a $1.25 that I'm collecting today. And if I'm right, the price goes up a lot, nowhere, down a little. I collect that $1.25, and that is mine as the options, as a credit spread trader here. That is mine. I collect the $1.25 and I keep the full credit. Now, if price goes below $7.95, that's where we're going to start talking about what's my risk, what's my reward. So I have a $3.75 risk. on this trade, right? Because it's a $5 spread and I collected $1.25. So that's my risk, which means the most I can lose on this trade, if the stock goes to $500, if the stock goes to $1,000, if the stock goes to zero, the most I can lose is $375 if it goes below my $795 long put. Okay. So what happens, and you're getting into like some pretty good stuff, because if we talk through this example, you should have a good understanding of why credit spreads are great, and also the pros and cons of knowing when price does this, what happens. And that's where most people get lost is, you know, in the event that SMCI drops and goes way below these levels. Remember, this is a buyers and sellers market. There are people that if you are short SMCI and this thing drops $100, most likely those option traders are going to want to get rid of their long puts for profits. And so they're going to, assign that to me if I'm an option seller, right? If I'm doing the credit spread, I can get assigned. So let's say that, again, this is all just example here, but I know that if I take this trade, my max risk is $375 because I'm getting paid the $1.25 up front. I have a $5 spread. All I have to do by expiration, and I think we went out, like 30 days or something like that, is by the time that my option contract expires, as long as price is above $800.01, I make full profit on this trade at $1.25. That's all I needed to do. So from a percentage standpoint, if the stock drops, let's go down to $800. So if we drop to $800, which is going to be somewhere around a 9% dip in the stock, I still make money. Okay. If the stock stays where it is, I make money. If the stock goes up 1%, 10%, 1,000%, I still make money. So I have 3 or 4 situations that allows me to make money as this credit spread trader. Now, if the stock drops, let's say that it goes down to 750. All right. And Frank, you're going to answer these questions for me. Okay. So let's say you'll be fine. Let's say the SMCI drops to $750. Okay. You still have the credit spread with the 800 by 795. What's the most you can risk? If you have an 800 by 795, what's the most you're risking on your trade?
Is it not 375?
It's still 375. That's the most you're going to risk.
Okay.
But in the event that the stock drops to 750, and as an options market that has buyers and sellers, if you get assigned the stock.
Oh, so you'll own it at 800.
Exactly. So let's say the stock drops to 750 and you are assigned at your sell put level. Okay. So you're assigned at $800, just like you said. And remember, you collected a $1.25 premium on the credit spread. Okay. So your break-even price, if you wanted to say, you know what, I'm okay owning SMCI because I think it's going to be, I'll give it a chance to come back. Break-even price is going to be $798.75, right? We take out $1.25 off that $800. So that's my break-even price. Now, price is at 750. I have a long put option at 795 and current price is 750. So what is the value, Frank? What's the value of my long put option? If price is 750 and my long put option is at 795, what's the value of that stock or that put option?
Is it the difference between those two numbers?
Yeah. So 795 minus 750, that's a $45 value in my long put option. Okay. So in the event that you're like, you know what, I don't think SMCI is going to dip much more than the 9 or 10% or the 15% that it did. I'm ready to own this thing. I think I can own this kind of near the bottom if we start to see a dip from here or a bottom. So we could, and this is what traders have to think about. If we can, number one, afford to take the assignment and own the shares, if I want to keep SMCI, then I have a break even of $798.75. Okay. And then I have a $45 long put credit that I could cash in for. And then what's my new break even? What's my new break even? Again, we're just doing math here. And one thing I haven't found is I've done a lot of options trading. I've traded a lot of platforms. You still have to do it by hand. if I'm doing this type of stuff, you still have to type it out longhand. I could show you guys like notepads of like just handwriting all my little break-even levels and then transferring it into a spreadsheet. But that's kind of the old school way to do it. But it's still, this is what's important. If I own if I get assigned with the credit spread 798.75 and I have a $45 value in that long put, I could actually own the shares, even though the stock price dropped from 876 all the way down to 750. I could own the shares of SMCI following that drop down. I could own the shares at 753.75. So if you wanted to, you could own the shares here. And what are the chances that that stock, maybe jumps up to 765 or jumps up to 775? Probably pretty high. Again, there's risk in trading, right? So maybe it keeps going down and you're going to be holding it there, but there's other stuff we could do. So I'll ask you this, Frank. Do you want to own your shares of SMCI at $753 as opposed to $800, as opposed to, $798? Do you like the fact that you could actually lower your cost basis?
Yes, but I am a little confused still about getting assigned at getting assigned at 800 and then being allowed to own it at 753. That kind of just went over my head there.
Yeah, let's break it down again. So the reason that remember you're assigned, let me just put another text box here. So you're assigned to 800, right? You did a credit spread. Your credit spread collected the $1.25. So automatically, even if you took the $800 assignment, you're lowering your cost basis by that $1.25 because you have a long put, right? And that's essentially your protection. And that long put has value. Think about how this trade works. The broker doesn't assign you anything at $795 because that's a long option. The broker assigns you at $800. So when you look at your platform, if you got assigned, what you're going to see is 100 shares long, $800. You have to remember, and you have to have this written down, that yes, I was assigned $800, but I collected my $1.25 on my credit spread, and I still have an active long put option that's running in my favor. Does that make sense?
Okay. So you're saying it's like owning it at 753.
So if I close, and here's what would happen. If I close my long put if I close that 795 long put and I close that for the $45, that's when I would own the shares effectively at that 753, right? Because I was assigned to 800, collected my credit spread credit for $1.25. Let me just type this out as I talk. Maybe it's a little bit easier. So I collect my credit spread, and then the long put protection, I close for $45 credit. This is where we just do the math. So you have $800 assignment minus the credit spread credit, which was your $1.25, and then also your long put for credit, 45? Which is $45. And so that gives you your effective or net break even at 753.75 cents. So let's make sure I did the math right there. I think we did. Where's my mouse? There it is. Okay, so let's put that there. And we get assigned to $800. We collected our $1.25. We close out our long put now for another $45. If I did that and I'm now square in my broker platform, I had the assignment. There's no more long put option. Right? And I just sit on the shares. I know that my break-even level is 753.75 cents. Now, again, what the broker platform doesn't show you is this. It doesn't show that you own it at 753. It shows that you're assigned at $800. So that's the tricky part, is if you don't do the simple math on this, you don't know that you are owning the shares because of the credits you've collected and the long put that actually was profitable for you. And so this is why it's nice. This is a kind of an extreme example because this is a crazy expensive stock. And even if I own the shares at $753, that's 75 grand on 100 on a one contract, right? If it was 753 and it's times 100, if I just have 100 shares to control an option, I need $75,000 in cash. Now I need about probably $37,000, $38,000 in margin, but That's a big account to take that type of position, right? So here's what also happens. Frank, do you have $75,000 to take the assignment?
Nope.
Okay.
Not even.
I don't either, and I don't want to take the assignment. So here's what I do. I don't do anything, right? If price drops to 750 or drops to 700 and it blows through my credit spread, I'm just going to accept the full loss at expiration for 375, and that's my exposure. I lose $375 on one contract. I'm out. If I get assigned, and this happens a lot, so this will happen if the stock's selling off a ton, brokers will assign you because it's an option buyers and sellers market. So I see this all the time, and traders will freak out. If you're ever teaching options, traders panic when it's like, I got assigned SMCI, I'm upside down $40,000. What happened? All you have to do is close out your long put and then close out the shares. So let's talk about that. And this is what I said. You asked a great question to have this be a lesson from start to finish. If you're a credit spread trader, what does it mean? What do you collect? What are the pros and cons of these trades, right? I'm hoping this makes sense, where the pluses are there's like 3 or 4 ways out of 5 you can win. The minuses are you just have to do some basic math and understand that if price goes against you and it goes, inside your strikes or through your strikes and it's in the wrong direction, you just have to know the consequences of that trade. So let's go ahead.
Like conceptually, without any math, you can say that as opposed to buying or selling a put all on its own, a credit spread allows you to cushion your drawdown more, as in your assignment price is where you would basically, I guess, lose value on the put option that you're selling, and you're owning at a higher price. But what a credit spread does is it allows you to have more room for that trade to run down. So instead of an $800 assignment, you collect money on your put, and then you basically own it at a lower value than 800. So you're not necessarily losing money, as opposed to if you were to just only do a sell put option.
Yes. If you did a sell put option and price did, in this example, if price went to 750, you're going to own at $800. You're going to own it at, $798, $75 because of that initial credit spread. Or actually, let's do this. Let's go back to the platform really quickly. If I just did a naked put, so if all I did was sell a put, I can collect $5.60 on that put. Okay. But check this out. If you can you see the font on my charts? It's pretty small, but if all I did was sell the put and I can collect $5.50, my buying power is reduced. And this is a margin account, but my buying power is reduced by $48,000. Okay. My max profit on this is I need price to stay above $800 and I can make $550. So my max loss is if the stock goes to zero, okay, I collect my $550 because let's just do one contract. So I collect $550. Look at my max loss. My max loss is if this stock goes to zero, I am on the hook for all of that. And I sit here with an assignment at, $800. Right. So the credit spread, like you said, I think cushioning is a really good phrase. So the 795, what it does is I just want you to just pay attention to these numbers here. Look at the max profit versus the max loss and versus the effective buying power reduction. Watch this. If all I did was add the spread, now we go from a buying power reduction of $415 versus $48,000. We go from a max loss of $79,000 to a max loss of $420 with a profit, instead of being at $550, now it's at $90. Now it's it's $1. So there's trade-offs, right? There's pros and cons, but if you think about trading, what's the most important thing to manage? Your risk.
So less money can be made on this, but it reduces how much you can lose and like the probability of losing.
Exactly.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.